Hi, this is Daniel, and you're watching Unrivaled Investing. This is a no hype financial channel that is mission focused on finding you exceptional companies and unrivaled investments. Today, we are looking at Doordash new IPO. Dash is going to be the ticker, so it's Dash stock. We're looking at Dash stock, trying to figure out, is this a compelling buy? What's going to happen? So new IPO coming out around December 7th. They're growing revenues over 200% growth in 2020. And this video is to go over everything you'll want to know about Dash as a potential investor, the business model, their target opportunity, the valuation even. But before going in, a quick 10-second plug. If you enjoy learning about potential multi-baggers, make sure you subscribe if you're already a subscriber. I appreciate the love. And if you want to follow my personal journey to try to find you potential multi-baggers, go to unrivaledinvesting.com, click on journey. All right, let's dive into Dash stock, Doordash. So what is Doordash? It's the number one food delivery platform in the United States, with recent entrances in the Canadian and the Australian markets. It is a behemoth with 400,000, approximately a little under 400,000 merchants on their platform, 18 million customers, 5 million paid monthly subscribers that are paying to get unlimited deliveries a month, 1 million Dashers who are the drivers, but that's only where they are today. So I'll talk about the potential for the future closer to the end of this presentation. But first, a little company history on Doordash. And so it was founded by Tony Xu when he was 5 years old, when his parents immigrated from China to the US. His mom was a doctor in China, but her doctorate degree wasn't recognized in the United States. So she had to work 3 different jobs for 12 years, one of which was a server at a Chinese restaurant, where Tony got a front row seat often as a dishwasher, where he was doing work as a young kid. So when I look at Tony Xu, I'm thinking, this man, he sees, he's coming from immigrant parents. This man's going to have a hunger. He's gotten front row seat first. He's gotten the experience that you need to see of what goes on with restaurants, and he's also going to have a hunger to succeed at all. He will make it happen. That's what I think when I look at this background. So as a student at Stanford, he asked dozens of local businesses about their pain points. What could we do that would improve your business? And he was surprised to hear that delivery was an issue. Outside of New York City, very few businesses at the time offered delivery. And so in 2013, Doordash was launched, and with the premise of making it fairly easy for restaurants to establish their online presence. And you can go online, and they make it even simple now. It's you don't even need to have a human really involved, where it's about, tell us about your restaurant, upload your menu, and then wait, you cook and we deliver. We make it happen. So what's the value for the restaurants? Why would they want to sign up with Doordash? I already talked about that it's somewhat of a pain point, but let's sort of dig into that a little bit. So first of all, it increases their business pretty significantly. You get exposure to all the customers that could potentially be shopping for what they have, all the customers that are on the Doordash platform. And Doordash has 18 million customers on their platform. So automatically, it's like you're getting exposure to thousands, potentially more customers in your local region. Then restaurants, the way to think about it is you have fixed costs. You have to pay your rent. You got to pay these salaries. Hopefully you get these tips. This is, I'm talking about excluding COVID impact and all the different changes there. Sort of a normal environment is you have a lot of fixed costs that you have to cover. And so the way this works is that this is 80%. It's not cannibalizing existing business. 80% is new orders, new customers. So it's new incremental business, plus it's higher margin business, more profitable business, because it's business that at the end of the day, even though Doordash is going to get a cut, and it's a big cut, and we'll get into those unit economics in a second, even though there's this big cut, it's still new business that's coming in the door, and they already are marking up the food fairly significantly. So it's and also it's not food that needs to be waited on. So you don't need to have that staff for waiting on them. You don't have to worry about whether or not my restaurant's at capacity. You can just deliver this incremental business. So it's higher margin, it expands your sales, it helps cover your fixed costs. They also have platforms that, for example, enable in-person pickup. So that way, hey, if you don't have that functionality or setup, they can do that for you. So that way, hey, if you want to have people be able to pick up the food straight from your restaurant, boom, you get your online presence. And so by making it, you're increasing your brand presence, improving your margin, reaching out to new customers. These are all the key aspects. And by getting more and more merchants, more and more restaurants onto your platform, you start creating this flywheel effect. And this is hugely important when you think about Dash stock or Doordash stock or Doordash as a company, because the flywheel is a key element of their value proposition and their competitive advantage, where you have more merchants, more and more merchants sign up, which results in more selection. So then the consumers go, oh, I'm going to stick with Doordash because I can get these restaurants that, I've never tried before. I'd like to do this. So then you get more consumers. More consumers mean more sales. But then this also works with, the more sales you have, more merchants, there's going to be more drivers. And more drivers, mean faster deliveries. So then you're going to get more consumers. So then more consumers show up. You get this network effect, you get this flywheel, you get this platform where it actually would be fairly tough for a new player to come in and try to disrupt them, because you would need to have each of these components. You'd have to have three corners here of this triangle to make this happen. You need to have the consumers, you need to have the dashers or the drivers, and you need to have the merchants or the restaurants in order to make this business model work. And they've invested the hundreds of millions of dollars to make this work, to get to this scale now. We're talking about 400,000 restaurants, 18 million customers, 5 million subscribers. So you're getting this flywheel of, oh, more orders. More orders means more earnings potential for the drivers. Oh, so there's more drivers now, so you're going to get faster delivery. More consumers. Oh, now you have national recognition, so you know what? More major brands are going to come online. So you're going to get some of the top brands. And that's what, in terms of national chains, that's what Doordash has. Doordash has something like 175 of the top 200 national chains in the United States. The way to think about Doordash right now is it's predominantly a US company with toeholds in Canada and Australia. Okay, so this flywheel dynamic, this looks really good, but it really only works if they have significant market share. And so do they have significant market share? And they not only have gone from 17% to 50% market share. So they are taking market share. Now, I need to caution this or pause this a little bit, because this is a little deceptive, because it included an acquisition that they made of Caviar, but that was probably only a couple percent of the market. Overall, most of this is reflecting a stronger value proposition, whether or not it's for the consumers, the dashers, or the restaurants, that they've had a more winning formula that's resulted in them taking share from January 2018 to October 2020, where now they have 50% of all restaurant deliveries in the United States. Next up you see Uber Eats, and after that's Grubhub, and then Postmates. Interesting, Postmates just closed a deal with Uber Eats, so now Uber Eats is going to be a bit bigger. So Dash does have plans on expanding internationally beyond their positions in Australia and Canada, but good luck. You have several international competitors that have had years to build out this very flywheel that they're going to try to disrupt. And so that is going to be a very expensive proposition for them to consider. That said, they are raising $3 billion. So, any potential market, I would argue, is fair game. It just might be very costly. What about their business model? And boom. So let's walk through the economics of their business model. And you can see that here is an example of a transaction where a consumer goes to a restaurant, he orders food for $22.40. In it includes $170 in taxes. You tip the driver about 14%, so $3.30, and then there's fees of $5.50 that DoorDash is going to charge. So all in at $32.90. So on a $32.90 transaction, $9.50, so that's $5.50 here for consumer fees and $4 for merchant fees go to Dash, or nearly 30% of this transaction go to DoorDash. But when they look at revenue, the way to what's the actual revenue of this business, they actually only look at $4.90 of it, because the tip 100% goes to the Dasher, and they also back out these fees that they pay the drivers. So this amount that they get isn't consumer fees plus the commission and fees from the merchants. It's a net of what they pay the Dashers and what the restaurants get. So it's a net fee. We'll talk about that in a second, but all in, that represents about a 15% take rate on top of the total price. Let's go through each of these components because it's so important to understand whether or not this is a sustainable relationship, because you need a sustainable relationship to make this work long term. So first, in terms of the consumer, the consumer with tips and fees pays about a 37% premium to have the conveniences and accessibility to a huge selection of options. So, you have it. If you went to the restaurant, it would cost you $22.40 plus $1.70 in taxes. But when you layer in the tip that you're going to need to do for the driver, you're going to need to layer in, consumer fees of $5.50, effectively DoorDash platform fees. You are paying a really hefty premium, like 30-40% premium off of what you would have paid. That said, it is about convenience, it is about accessibility in all the restaurants that are at your fingertips. This accessibility is partly why DoorDash is actually growing even faster in non-metro areas where the tier 1 cities are less than 40% of their business and are growing slower than the tier 2 and below cities, which is interesting. It's because as let's say a consumer in a tier 2 city, you have less restaurant selection easily available to you within, let's say, a 25-mile radius, or stepping immediately outside your home. And so you'd say, you know what, I'd rather have a driver drive that 20 miles and bring it to me. And so that's part of the reason why. In tier 1 cities, you sort of have lots of saturation. Think of New York City. Think about all those potential restaurants that were open certainly pre-COVID. Just so many different options the second you step outside. Whereas the more rural, the more suburban, the options are further and further away. So the appeal, the accessibility of having a delivery platform is that much more valuable. And their market share of the tier 2 and below cities is actually closer to 60% versus their consolidated market share of about 50%. So that's from the consumer side. Then let's look at the Dasher side. Now, the Dasher only gets $7.90 out of this transaction, this $32.90. And so the first reaction is oh man, you got to be delivering 2 to 3, deliveries just to be sort of a sustainable living wage in the United States. And also a big challenge here is this assumes a $3.30 tip goes into this. So, and that's about a 14% tip. So with 100% pass through. So DoorDash doesn't get anything on the tip. They don't take anything. So without this tip, it is very clear based on their unit economics that they're spelling out that it would not be sustainable for these Dashers to have, to have a living, to have a sustainable job. This whole model falls apart if consumers don't tip. That just needs to be clearly understood. So the next time you order food, make sure you tip generously. Because if you're backing out this $3.30, you're talking about $4, and you got maintenance of a vehicle. How many deliveries are you actually going to do? And so then you get folks pushing back, and you've had legislation in California say, hey, you need to set some minimum standards, and the legislation is working where it's sort of saying, hey, you're going to get a minimum coverage of X cents per mile that you drive. If you do over X number of hours a week, you're going to get health coverage. That said, it's not like the Dashers are forced to do this work. They can opt into it versus, let's say, a Lyft driver, or they can pick their own schedule. No one's forcing them to do this job. They are opting into it, and there's a million Dashers at the end of the day. So that would suggest that there's enough tips, or there's enough orders that are for much bigger. Let's say you're ordering sushi for $100, and there's enough tips and sizable fees that the Dasher's getting a livable wage that's $20 up. That's what this model would say is you need to have the tips, you need to have bigger orders going through. How about the merchant? So from the merchant, I already mentioned that they're getting, a lot of extra business. 80% is incremental and more profitable business. But they only keep about 80% of their pre-tax bill, because you can see this 2240, $4 goes to commissions and fees. So they only keep about $20, all in of what, what they're billing off of. So this is $22.40 for the food, and then another $1.70 for taxes. They're only keeping about $20. And so all in, DoorDash is keeping, revenue from this $32.90 transaction of $4.90. And this leaves Dash, like, let's understand these economics a little bit better. And boom. So you could see, what they've done over the last few quarters, where the amount of business going through their platform has gone from 1.5 billion to 7.3 billion in the third quarter 2020. So you're looking at an annualized business of nearly $30 billion based on their third quarter, and they're growing about 200% plus, over 200% in 2020. And so that's the first reaction, is like, well, wait a second, Daniel, like, COVID obviously plays a huge part. Like, maybe they weren't growing at all before then. And the reality is they were actually growing really fast, because in 2019, pre-COVID, their same-store sales for their merchants, so their existing merchants on their platform, grew their business 59% in 2019. So the merchants that were on their platform were getting that uptick in getting exposure because they were on the DoorDash platform, resulting in much better growth in those stores. So that does support the thesis that this is a win for the restaurants. So the revenue, when we think about revenue, because I mentioned it's a little tricky, because revenue for DoorDash is net of what the restaurants get, net of what the dashers or drivers get. Net is, so you should think, like, the margins on this, you're already paying these huge allocations, these huge expenses, like the drivers are going to be a big expense. So you'd think the margins should be really high, software-esque, platform margins, and they should be pretty high, except you do have several big expenses, and the big expenses are partly tied to the total amount that goes through their platform. For example, the payment processing charges. I'm thinking payment processing charges, let's say, are being charged on the total amount of the bill that they have to go, that goes through them. And so I'm thinking that's probably 15 to 20% of their revenue. Then you have customer support. Customers like, dude, my food's cold, or this driver was rude, and the store is like, hey, how come, the restaurant's saying the driver's not showing up, or they picked up the wrong food? You gotta have customer support, you gotta have refunds. So, I'm thinking payment processing charges, 15 to 20%. This is my ballpark thinking on how you get to their current gross margins of around 50% plus. So you have customer support, and you're onboarding new merchants, like onboarding new restaurants. How do you make sure it's a seamless experience? So if you have 50% plus gross margin, what's the long-term potential when you look at Dashstock or DoorDash? And here's where it's helpful to look at their next largest competitor, Uber Eats. And here's what Uber Eats is penciling out. They're penciling out 30% adjusted EBITDA margin and 15% take rate. The take rate means for every dollar that goes through your platform, they're getting 15 cents of it that goes to them effectively as revenue. And that's really interesting to see that they're using the same take rate as DoorDash. I'll have some thoughts on that for my Journey subscribers that'll be exclusively for them at the end. But that's I think that's interesting, especially given the fact that their sample, unit economics, they're currently around 11 to 12% take rate, actually, like where DoorDash is now. So clearly getting to the 15% is something that's aspirational, one would say. And you could see that part of the reason why their take rate of 11 to 12% is sort of hampered and not at the 15% yet is, here's a chart from DoorDash where you can see their 2016 cohorts, 15% take rate, 2017 cohorts, 15%, 2018 cohort, 13%. This is interesting. This means that they can effectively manipulate exactly what take rate they're getting based on what year you signed up as a customer. So they have those levers at play to figure out how much they're going to be charging, and based on when you start up, you know, the most recent customer cohort, so let's say the 2020 cohort, which is probably the biggest cohort yet, is going to have the lowest take rate. But over time, as customers become repeat customers, you slowly bump that up from, let's say, 10% to 15% over time. So what's the long-term potential? What's the valuation when we look, you know, at DoorDash? You know, how should we think about the risk reward? And I actually walk through a potential upside downside case, but let's first talk about valuation. And it's funny is that the valuation, it's not really as loved, you know, by all investors, and it is getting a fairly full valuation, where you see, here's an article saying DoorDash sets IPO terms pushing valuation as high as $32 billion, putting the stock at $75 to $85 each, selling 33 million shares. And then here's this opinion where he goes, this stock sale is the most ridiculous IPO of 2020. Don't be the stupid money. Don't be stupid. So I thought some of my reviews were harsh. You know, I got a lot of grief for Hyliion and Momentous views where I was just like, you know what, too hard for me. Hyliion, I gotta say, you know what, that call was pretty fair. If you want, viewers can go back to that. So I thought personally my reviews were harsh, and here it is. They're telling anybody to invest in it that they are the stupid money. And here's, you know, an excerpt from their article where, you know, is it a coincidence that DoorDash filed for its IPO soon after vaccines for COVID-19 were announced? We think DoorDash's current investors and bankers recognize that the window of opportunity to IPO this terrible business closes quickly when the threat of COVID-driven lockdown no longer drives growth in food delivery demand. That does raise a fair question of what does revenue look like in 2021, but we'll get to that in a second. They keep going at a valuation of $25 billion. It earns our unattractive rating and would be the most ridiculous IPO of 2020. We think this proposed public equity offering holds no value, $0, beyond bailing out private investors, those evil private investors that make capitalism work, before unsuspecting public investors. Oh, whoa, the public investors that can't watch awesome YouTube channels that educate them on stocks, realize the business is not viable in its current form. This IPO reminds us of WeWork's attempted IPO, which we called the most ridiculous IPO of 2019, because DoorDash's business is similarly disadvantaged. Then they go, it's not a good idea to invest in businesses that have no moat, no profits in the best possible environment, no profits in the best possible environment, and competition that can offer the same service for free. Whew, that's rough, man. Jeez, tell me how you really think. How you really feel. So first, investors apparently disagree because the initial price now has gone from $75 to $85 to $95 a share. Second, I think this is actually a really bad take on DoorDash and the industry at large. For example, how many competitors can really offer what DoorDash has? 18 million consumers, 1 million drivers, 400,000 restaurants. Like, how many competitors can spend billions of dollars to catch up? What would be the incentive for that restaurant to do business? What would be the incentive for that driver to do business? For the consumer to do business? Like, I think that would be a really tough hill. And investing is not backwards looking. You're not looking at the lack of profits in the past. You need to be forward looking and thinking about what are your optimized margins in the future, because that's ultimately what it's going to be valued on 5-10 years down the road. Plus, they have 5 million Dash Pass subscribers where they pay like $9.99 a month for several, where it waives your fee on deliveries that month with special DoorDash selected stores that get extra business that way. So I'm looking at this and I'm thinking, no, you're not right. This is a bad take. Like, I think this is a lot harder of an industry, and you're seeing consolidation in the industry because it's so hard. And the reality is DoorDash is helping to expand the pie. They're making the pie bigger, and yum, that pie looks delicious. Even though it's post-Thanksgiving, I still have that pie craving. Now, their marketplace volume was 8 billion in 2019. So it's clearly grown a lot. Versus 303. So the total volume that went through their business in 2019 was 8 billion versus total amount spent in restaurants in the United States. So the off-premise at restaurants was a little over 300 billion. So at 50% share, this implies, because they're saying they only have about 50% market share of that 8 billion. So that means about 16 billion all in is doing this delivery. That implies that about only 5% is going, this online delivery. That leaves 95% of the amount of money that's being spent at restaurants still the old way. Now keep in mind, this is 2019, pre-COVID. Things have certainly changed a lot. But I would argue long term, when we get back to normal, you're going to have, bumps in how this plays out in the months and quarters ahead. But I would argue that they are expanding the pie of people accessing restaurants, especially people that are not in tier 1 cities, where, getting food delivered via an app could be, let's say, 15 to 25% of what's spent in total on restaurants, maybe even more. Because of a convenience factor. Maybe you start getting, electric vehicles where the cost goes even lower, or maybe you have autonomous vehicles, or some sort of hybrid solution in the next 5 to 10 years, and that becomes part of it. So, wouldn't that be kind of a sweet gig if, like, you're in a Waymo or an autonomous vehicle and you're sitting there and you can work on something else, and then you go to the restaurant, you pick up the food, put the food in the car, press go, and then you get to work on something else while the car takes you, you drop off the food. That'd be the easiest 10, 20 bucks, an hour job out there. Plus you could effectively work 2 jobs at the same time. Snap! So that said, they did get a COVID bump, and so it will be volatile, I'd argue, in the quarters ahead, the months ahead. Like, what does, revenue look like in 2021? What does revenue look like in 2022? Like, you've clearly gotten this acceleration. Now, they were growing super fast pre-COVID, 60% plus from their same-store sales. So, do you have this pullback where everyone's like, yes, I'm so happy to be eating inside a restaurant where no one does DoorDash, and then it sort of resumes back? There will be that dynamic to it. But this is an example of DoorDash expanding the pie. They are not thinking. Tony Xu is not thinking about just being a restaurant business. He's thinking groceries. He's thinking about your toilet paper needs. He's thinking about your prescription needs. He's thinking, wait a second, what are other things that we can tap into this network of 1 million drivers that can help ship goods to you, make your life easier? And so you can start thinking of, let's just layer this in, effectively become a courier platform with food as the stable. And you start layering on things. Let's do groceries. Let's do prescriptions. So I definitely think there's a courier aspect to this where it could definitely, get even bigger in the future, expand that pie. What about that valuation? Now, this is part of my value proposition to you, is I provide this sheet in the description of this video. You can click on it, you download it, you play around with the assumptions. I try to provide a logical framework for me to think about stocks. I need to sleep well at night, so I need to have some logic. It can't just be phony baloney. Let's just, everything goes straight up. And so I lay out logic. Could it go higher? Could it go lower? Of course. But, you can get animal spirits. And I'd argue there's a lot of animal spirits out there right now. But I want to see what's a logical take. And so let's break this down using my best guess at a logical take. And so currently, we got to up the share price to 95. That's what the latest articles are saying. 350 million shares outstanding. That does include, a lot of additional dilution that they have. So all in, that gets to around $33 billion valuation. Then next up, you had revenue of around 900 million in 2019. And then this year, they're clearly growing around 200%. So I put a range of 195 to 230. 2.6 billion to 2.9 billion. That's pretty incredible growth that they're seeing. Then what's that margin? So, Uber Eats, you're saying 30%. they're bigger than Uber Eats in the United States. And keep in mind, Uber Eats is profitable in certain markets in Europe, for example, that DoorDash hasn't touched. So I'm saying, you know what, let's use this logical framework. Like, their revenue, keep in mind, should be high margin because it's excluding some of their big expenses, like the Dash driver, expense, the DoorDash driver expense. And so, I'm thinking margins for this could be 15 to 25%. If Uber Eats is penciling out 30% EBITDA margins, then maybe 15 to 25 is reasonable. Apply some sort of tax rate to it, and you can see that this implies about 60 to 113 times earnings. So then this is the really tough question of what does the growth rate over the next 5 years look like? 21, 22, 23, 24, 25. What does that look like in the coming years? And, in my downside case, in my low case, I assume 10% because that's a smoothed 10% annualized over 5 years, because the reality is you're going to have a lot of this, is what I suspect. Now, the upside assumes like, hey, even after even after people start going back to restaurants, you know what? People still like this general trend, and you start layering in markets like pharmacy and groceries, and so you're able to put up really attractive growth over time. So that way you're actually triple what they're estimating to do in 2020. This might be aggressive. I'm not sure. This is 3 times 2020, and this is 1.6, so 60% growth off of 2020. So then what sort of multiple do you want to assign to this? It's a platform. By then, in 5 years from now, it might be obvious, especially if they're putting up attractive margins. It might be obvious like, hey, competitors aren't going to compete with them. They do have a moat, in which case you do get a really attractive multiple. Maybe you get 40 times. This depends on what your growth rate and what your margins look like. Part of this is that it starts sort of feeding on itself. Oh, you have good margins and you have good growth. Let's assume a higher multiple. And then on the downside, the growth isn't as great and the margins aren't as great, and so I'm putting a 20 times multiple because it is a platform. But in reality, using that sort of multiple does result in about 70% downside, what I'm penciling out here, if it goes public at $95 a share. Whereas in the upside, I'm sort of penciling out $100 a share. So sort of, upside, downside, 1-to-1 sort of payoff is the way I'm thinking about this. I actually think, as you can sort of tell, I actually think DoorDash is a pretty good business. Their U.S. operations, their U.S. business could be a phenomenal business. It really depends on industry cooperation. John D. Rockefeller would never say oligopoly or monopoly or trust. He would always say cooperation. The billion-dollar question is what growth rates look like in 2021 and beyond. That's really the huge question. That investors need to think about when they look at DoorDash stock. And if you're interested in learning more about DoorDash, the industry, potential follow-on effects to other players, that's something that I'm providing exclusive content just for Journey subscribers. I'm going to post some additional thoughts either later tonight or later this week about these dynamics, what I think DoorDash stock will actually do, and potential acquirers, thoughts around that. So that's just one of the perks that unrivaledinvesting.com Journey subscribers get. And ultimately, my value proposition to Journey subscribers is a couple. So at the end of the day, I'm trying to help you on your journey by sharing my journey. And each month, I'm trying to identify one potential multi-bagger. So that's the type of stock that can go up hundreds or even thousands of % over time. With the journey, I also post an educational post at least once a month. So I'm developing an educational series to help you on your journey as well. So then there's exclusive content like what you have here. And there's also a monthly update of my own personal portfolio about what I buy, what I sell, and what I hold. And you can see a full catalog of contents of all the exclusive posts. I'm going to put it below in the description of this video. It'll be called the Catalog of Contents. You can click on it if you like. And the reality is finding just one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these multi-baggers, go to unrivaledinvesting.com, click on Journey, And if you enjoyed watching this video on Doordash, which I hope you have, please subscribe. And if you're already a subscriber, hit that thumbs up. Thank you so much for watching.